Hi, this is Scott Hastings with Mortgages by Scott. If you are wondering what a 2-1 buy down is, then you're in the right place. So, this is being recorded in November of 2022. It's the week before Thanksgiving. This week, mortgage rates dropped, well, significantly uh, as far as mortgage rates go. So, right now, we're in sort of the high six range, which still is about 3% higher than we were earlier this year. So you may be a lot of other buyers out there where what you were thinking you were going to be able to afford earlier in the year is much less. And if you're in the situation where you can afford the payment as far as actually, you can qualify for the mortgage, the payment just doesn't feel comfortable for you, then that's where a 2-1 buy down might come into place. What I've got on my screen here and what I'm going to go over is really how the, the product works, what are the costs of the product, who pays for it, and again, who it might be good for. So in general, what a 2-1 buy down mortgage is kind of like what it sounds like. For the first year, the payment on the mortgage is calculated on the current interest rate minus 2%. So on my screen here, I've got 6.875. That means for the first year, if we look over here, the payment is going to be based on a rate of 4.875. So this is where people get a little bit confused. The real rate is really 6.875. This is not an adjustable rate mortgage. This is a 30-year fixed rate mortgage. It's just that the payment is lower for the first 2 years. Well, how does this work? The key is that this is going to cost the seller to do this. Only the seller, and if it's a builder, which again will be the seller, they're the only ones that are allowed to pay for it. The buyer cannot pay for this. What happens is that difference in payment. So if you can see the screen here, we're showing a purchase price of $550,000 with 10% down payment would be a loan amount of $522,500. And then that would again be based on 30 years, 360 months. So the payment for the first year, just the principal and interest payment, would be $2,765. That is $667 lower per month than the fully indexed payment. You add that up over a year, that's a little over $8,000 a year. So the second year, the payment basis steps up to as if the rate was 5.875. Again, the real fully indexed payment is 6.875. So the second year, instead of the fully indexed payment, which is $3,432, it would actually be $3,090. So over, that's $341.67 less per month times 12 months is $4,100 a year. Well, it's not like this money is just going to disappear into thin air. The seller, again, is going to have to set up an escrow account where the lender, in my case, I'm the lender, we would set up an escrow account. And so at closing, the seller would have to put all these difference of payments into an escrow account, and each month a little bit will be pulled out to make the loan payment whole. So in this situation, that's going to be $12,108. That's 2.38% of the loan amount. So what happens, because there is a lot of speculation by people that are very smart in the mortgage industry, people that we follow, economists, they're thinking that rates are going to drop, probably as early as next year. And this isn't guaranteed, but it sort of looks that way. So let's say a year from now, 1 year's passed and rates drop. Now they are, well, for argument's sake, let's just say they're in the 4s. So you want to refinance your mortgage. Perfect. Well, you still got $4,100 left in the account. Only 12 payments have been made. You refinance. There's $4,100 left in the escrow account. That $4,100 would go to pay down the principal balance on your mortgage. Or another way to look at it would be, that would be $4,100 that could go towards the payment of your closing costs, on the mortgage. But in general, that $4,100 is yours. It doesn't disappear. So again, to recap, this is a 2-1 buy down mortgage. It is calculated for the first year where your payment is based on a rate that's 2% lower than the fully indexed 30-year fixed rate. The second year, the payment's based on 1% lower than the fully indexed 30-year fixed rate. And then if for some reason you didn't refinance, it would just step up in the third year to the fully indexed payment. Only the seller can pay for this. They put the money, which is the difference in payments, into an escrow account at closing, and then the lender or the servicer would make the payment whole each month. This is a great way, it's a great tool for a seller, because when a seller lowers their purchase price on their home, let's say they're selling a house for $600,000. Well, they could lower the price to $588,000, but that's really not going to change the buyer's payment hardly at all. What's really going to change the buyer's payment is if it's $667 less a month. That's huge. So I hope you liked this video. If you did, I would love for you to hit subscribe and like. That would really help me out. Again, my name's Scott Hastings with Mortgages by Scott. If you have any questions, you can just put them into the comment section below, or go to my website, which is mortgagesbyscott.com. Thanks a lot.